Hello everybody, and welcome to this new video entitled The Most Undervalued Growth Stocks. So in this video, I cover all of the stocks in my coverage universe, i.e. stocks that I've discussed on my channel, and I rank them based on valuation and valuation alone. So this is not the best stocks video. This is simply asking the question, which stocks are the most undervalued per the way that I value stocks. And so quickly, if you're new to the channel, on this channel, I focus on growth stocks, and typically the minimum threshold for a stock to join my spreadsheet is 30% revenue growth for the next 4 quarters, but I have to also see a long-term runway for that growth, right? It's 30% compounded. So ideally, if those 30% revenue growth lasts 10 years, that would be an outstanding stock to own. That's the type of stock that I'm looking for. Why do I want my stocks to grow revenue at 30% or more? Because my goal is to double monetary inflation. Monetary inflation I estimate at 15%. If I want to do a doubling in 5 years on any stock, I need to have growth of 30%, because the money stock out there, that's why I named the channel Beat the Denominator, the money stock out there is growing at 15%. And in order to do that, you really don't have a lot of choices. You really have to focus on growth stocks. So really quickly, what is my style of investing and how does this spreadsheet work? First of all, I don't use market cap when I value the price of a stock as a proxy for price. My proxy for price of a stock is enterprise value. It's enterprise value because I want to remove debt and punish companies that have a lot of debt. I take enterprise value, which a lot of other people in the finance world would say price, and I divide that enterprise value, my proxy for price, I divide that by gross profit. And why do I use gross profit? Why do I not use EBITDA or any of these other metrics? I use gross profit because my stocks are optimized for gross profit and gross profit alone. They are not optimized for earnings just yet, or even EBITDA. And therefore, these stocks are earlier on in their journeys as a company. Gross profit is the most relevant metric for my style. And if you see my metrics, the most important metric, the metric that I use to tell me whether a stock is overvalued or undervalued, is the enterprise value over gross profit over revenue growth. So this is a spin on the PEG ratio, and except I'm not using earnings, I'm using gross profit, I'm not using price, I'm using enterprise value, and I'm not using earnings growth, I'm using revenue growth. And so ideally, I want to consider a stock undervalued whenever I get under a 0.5 or 0.5 is what I consider undervalued for a stock. If you're familiar with PEG ratio, you know that the PEG ratio is under 1 is what you would consider undervalued, but this is clearly much higher up in the income statement, and therefore gross profit is much higher up. Many companies are gross profit profitable and they're not earnings profitable yet. Why do I do this on stocks that are so early? That's because of my style of investing. My style of investing is following the adoption curves, the new product adoption curves. The idea is you buy a stock, you get in early in a stock when you have early signs of product adoption, right? A good example of that is Tesla, right? And EVs, Tesla has about 4% market share of all vehicles sold. EV are about 6% of all vehicles sold. We're just at the beginning of that adoption. The S-curve is still ahead of us for EVs. And the whole idea is you get out once growth starts to slow down and once the company becomes more of a value stock. A good example of a company whose growth is starting to slow down, in my view, would be Apple. For example, Apple is now a great stock to own, but it's an older, steady Eddie type of stock that's not going to have returns from a company that is just at the beginning of its cost curves, right? Smartphones, everybody has a smartphone. We're past the adoption, right? But if you look Tesla, for example, or Enphase, which is a solar panel system, you drive around, less than 5% of houses have solar panels. That's a huge avenue for growth, right? Tesla is the same way. You drive around, less than 5% of the cars, less than 6% of the cars are electric. That's a huge avenue for growth. And that's why I focus on this S-curve very much. The stocks that I want in my portfolio will be early on in that S-curve. And that is the goal of this spreadsheet. That is essentially the goal of this spreadsheet. All of these stocks are earlier on in their cost curve, in their product adoption curve. So let me go and answer the question, what are the cheapest and what are the most expensive hyper growth stocks that fit all of this criteria? Well, the cheapest stocks, and there's 3 of them, I now highlight 3 of them in the spreadsheet. The cheapest stocks are HIMS. HIMS is still dirt cheap. Every single stock is bouncing, some of them doubling, some of them even tripling from January. And HIMS has only done a plus 30% year to date. So really not much compared to the other ones. The stock is still dirt cheap, still not noticed by analysts. The second one is StoneCo, a Brazilian company, the Square of Brazil. They do payments for small businesses in Brazil. And the third one is Lovesac. They are a maker of couches and bean bags, and they're also extremely cheap, because obviously nobody's ever going to buy furniture again because the real estate market is down. Anyways, I'm assuming that's what the market thinks. Or Mr. Market walks in very mysterious, odd ways. This company is very cheap. And let me move on to the expensive companies. And with the rally that we've had over the past few weeks, we now have many more companies that are expensive per my spreadsheet. So you may know that I've sold Nvidia. I'm out of Nvidia. I don't understand how Nvidia is so expensive. And I sold also Shopify. I don't understand the premium on e-commerce for Shopify is huge. I mean, there's stocks you can buy 5x cheaper than Shopify in the same sector right now. So Shopify is in my view extremely expensive for what you get. And we have newcomers. It's the Trade Desk. Last week was also the Trade Desk. Is now expensive. It's an old position for me. The market is envisioning coming out of the. Nobody called it a recession, but I've been calling it a recession. The market is envisioning coming out of a recession, and when we're coming out of that, what I call a recession, when we're coming out of it, spending on advertising will go up. The Trade Desk should benefit, so I think the market is seeing that. And then we have Palantir. And Palantir, in my view, it is getting caught in that AI narrative, in that AI wave. And that is why if the company just joined the ranks of an actually expensive stock in the spreadsheet. Very interesting, isn't it? Palantir's never been expensive. It actually used to be pretty cheap if you go back to these spreadsheets a month and a half ago. So Palantir is now expensive. I am not buying into any of these stocks at the moment. So what I do at this point is I'm going to go through each of the megatrend sectors that I've identified. Each of these megatrends I'm going to go through, and I'm going to discuss a little bit each stock in them and what I think about them. So let me get started with the energy revolution stocks. This is what I call the energy revolution stocks because it's beyond just the electric car. For me, what we're seeing in the world of energy is the whole idea that we have batteries that are converging with solar setups and solar systems. And it's cheaper to get batteries and it's cheaper to get solar cells, and that we're able to use the fusion in the sky. And the fusion in the sky, i.e. the sun, is, in my view, likely what is going to power everything in our civilization. And therefore, it is important, I believe, to invest in this megatrend. Solar, if you follow Tony Seba, I recommend Tony Seba. If you follow him, it's already the cheapest source of energy, period, in the history of the world. And whenever we have cheaper energy, we have revolutions. Think about how we were freed from agriculture thanks to gasoline, and before that, steam engines, right? Whenever we have a new revolution in energy, whenever energy becomes nearly free or has near zero marginal cost, we're going to have this revolution. There's 3 stocks that I follow that embody this change. There's more companies in this sector, but there's 3 stocks I follow on the channel that embody the change. The first one is obviously Tesla. Tesla is the Standard Oil of our day. It has its hands in everything related to energy, whether it is solar and its solar tiles, whether it is battery with its mega packs and power walls, whether it is charging for charging EVs and stations, whether it is now mining, they're getting into refining lithium in Corpus Christi, whether it is in actually making cars. Let's not forget about that, but it's not just cars, it's trucks. It's a whole array of different things. They have an insurance company. They're getting into making robots. They're getting into even selling electricity to people who want to charge their cars down here in Texas. They're just launching this for $30 a month. You get unlimited charging of your Tesla vehicles at your house for $30 a month. When you think about that, that really puts into perspective what I'm saying about the zero cost or zero marginal cost of energy. You know, why do I invest in a company like Tesla? Well, I believe Teslas will get adopted. It doesn't matter if someone thinks they're pretty or not. It doesn't matter when it comes, and I've made a few videos about this, but when it comes between 8 and 13 times cheaper per mile to drive, people adopt it. And it's important to not fall for the fake comparisons. People are like, oh, the pricing is really not 8x or 13x cheaper. Well, that's because people assume that you're going to be charging your Tesla outside the home. No. Most drivers of electric cars charge them at home. You take your car, put it in the garage, plug it into the wall, and you get that amazing rate to charge your car. It is 10x cheaper. It is a 10x cheaper technology, and we know that 10x gets adopted. Of course, Tesla is one order of magnitude better just from the energy standpoint. But you know that's not it. Like if it drives itself one day, how many orders of magnitude is that going to be? 2 or 3 is kind of a tie. I don't know if it's going to be twice as good, 2 orders of magnitude better, i.e. 100 times better than what we have now, or 1,000 times better. I don't know. All I know is that when products are 10 times, 100 times, or even 1,000 times better, they get adopted tremendously, absolutely tremendously. A good example to understand order of magnitudes, for example, is whenever you watch a keynote of NVIDIA and you watch the improvement that the processors of NVIDIA have gone through. Absolutely insane. We don't understand. We don't think linearly. We're not able to think linearly. This is a company that is thinking curvy linearly. This is a company that is thinking about S-curves and that is triggering multiple S-curves, and it's gotten more expensive. It's gotten a little bit more expensive because the market is easing up. People are looking out 6 months, 12 months from now. They're looking at lower rates, and Tesla has had a lot of good news recently with the charging, the universal charger. It seems like they're becoming the universal charger in the US now. Lots of rumors about factory announcements, etc. There've been a lot of good things going on, but to me, this is a stock, and by the way, if you look at my spreadsheet, it's almost above a 1. So I'm gonna have next week, if it keeps going up, I'm gonna have to put it into the more expensive ones. I'm gonna have to put it in there if it keeps going up next week. But this is a stock, Tesla. In the case of Tesla, this is a stock that, unlike Nvidia, I am not going to sell. And that is because NVIDIA, for example, and I will spend less time talking about NVIDIA, but NVIDIA, I'm not a video game player. I don't work in computing. I've never really set up a graphics card. I don't have the insider knowledge, or I don't have the insider intuition that allows me to have enough confidence to hold NVIDIA when it's extremely outrageously overvalued. When it comes to energy and when it comes to Tesla, I have absolute confidence, and I believe I have enough knowledge. I've studied the company enough. I've held it for long enough that I can have full confidence and hold it well into the ones. If it were to get well into the ones to me, that would not be a problem. Keep in mind also these numbers, whether it's revenue numbers, margin numbers, revenue growth numbers, they will update. Quarter after quarter, they will update. And whenever we get an update in these numbers, the EV over gross profit or revenue growth updates down typically, right? Because those numbers are going up. So this updates down typically. So the vicissitudes of Mr. Market overvaluing or undervaluing a stock, that matters in the short term, right? In between earnings. But after earnings, there's a reset. And you want that company, you want the numbers of the company to run as fast as the stock is running. I.e., if a company's revenue has grown 20% in 3 months, right? That would be a 60, 70-ish% growth stock. Like there's a few of those. If the revenue has gone up, 20% in 3 months, and the stock has gone up 20% as well in 3 months, there is no change in the valuation, right? It only gets out of hand when you have a stock that doubles and the revenue of that stock only goes up 15%. That's the whole idea about valuation. Anyways, let me move on. I've talked about Tesla enough. Let me move on to Enphase. I am buying actively Enphase right now. I hope to make a deep dive on Enphase coming up this weekend. I strongly believe in Enphase. There's multiple solar installers. The main competitor of Enphase, of course, is SolarEdge. But to me, it's about the technology for Enphase. What do you believe? Do you believe that microinverters is the future, that is hashing electricity, not using a bulky, heavy transformer system, but having a transformerless system where the electricity is hashed in a teeny tiny box that is just electronics that you place behind a panel, and you get into a scalable scenario where you have one panel, one tiny box under it, called a microinverter. And then the changing of electricity from DC to AC happens right at the panel level. Happens quickly. It's scalable. It's redundant, right? So if you lose a panel, I don't know, a tree falls on your installation and you lose a panel, you don't lose the whole system. You just lose that panel. That's the beauty of the Enphase system, right? Or if one day you have a lot of pouring rain, maybe sandy rain, and you have 1 or 2 panels that are very dirty, your whole system doesn't lose 40% of its efficiency, right? You're just one panel loses efficiency, not the whole system. You know how to update the system. You know how to clean the system. And Enphase, just like Tesla, Enphase has a vision just like Tesla. Tesla started out with electric cars, right? And now they're doing all of these different things that are going further and further away from electric cars. The same is true for Enphase. Enphase started out with microinverters, still the bulk of the business, but now they're doing all of these different things that are expanding the business of Enphase, such as battery storage, such as feeding in tariff with the grid, such as charging cars, such as virtual grids. They're doing a bunch of different stuff. Bidirectional charging, which is also going to be a big deal. Using your electric truck or your electric car as a store of energy for your home. And so imagine how many weeks your home is going to be able to live on just on a truck, like a big truck charged. Like it's gonna take a long way. Enphase is really expanding into so many different levels of the electronics of the self-sufficient home, the electronics of the independent home. Enphase is expanding in all these directions. Many tiny businesses around the main business, which is the microinverter business. Enphase is very cheap right now, growing quite fast at 43% predicted. Gross margin is fairly high for hardware maker. And then we have STEM. I'm not going to spend a lot of time on STEM. STEM is a small player. They have a software called Athena, which manages industrial scale storage facilities, that you would put, say, on an industrial site, and they install a lot of storage. They're actually a number one installer of megapacks, but they also install a lot of Chinese-made megapacks that are much cheaper. And so STEM is working on revolutionizing the grid and revolutionizing electricity at the enterprise level, and not at the residential level like Enphase is doing. STEM is not a competitor with Enphase, but it is interesting how they are both a competitor and a client of Tesla, which is a very interesting relationship. Anyway, I don't want to spend too much time on STEM. I spent quite a bit of time discussing STEM on the channel. STEM, of course, given the size of this company in my portfolio, and this is true. I think for for any wise planning, STEM is needs to be a smaller position. I mean, in my view, no investment advice, but STEM to me is a very small position because of this volatility that you can have on STEM. All right, let me move on to my healthcare stocks. I have to speed up here because I have a lot of stocks. Let me move on to my healthcare stocks. My healthcare stocks, we have HIMSS and we have Teladoc. I've sold out of Teladoc. I used to love Teladoc, but then I saw them do a bad acquisition of Livongo, and I saw that the execution was not very good. And the growth rate is really hindered by, I believe, the healthcare system. I believe the whole return to office movement is also happening into healthcare, and so people who are doing telehealth are now deciding to go back to the medical office buildings and do the visits in person. I think you may have a lot of legacy, more old school doctors who are also much more comfortable working in person. So we're seeing Teladoc at least a slowdown in my view. I'm not interested in Teladoc nearly as much as it used to be. This was a stock that was so compelling back in 2020, but the growth, unlike what many had thought, including me, the growth did not sustain itself. And perhaps it's a good idea to not buy stocks when we're in periods of extreme. I don't want to say hype, but extreme enthusiasm, right? Right now, like if you're buying Nvidia right now, there's a lot of enthusiasm for AI right now. Maybe not the best. I mean that's not what I would do because the enthusiasm is so high. You don't want to buy at peak enthusiasm. HIMSS. When it comes to HIMSS, though, I believe HIMSS right now is a lot of people don't understand the company. This company is very, very early. People do not like the product. People are literally turned off by the product. It's not a fun product to discuss. That's why I always discounted HIMSS. That's why I always stayed away from the stock. Like really investing in ED, that's no fun. Nobody wants to invest in that. But when you dig deeper under HIMSS, you realize that it's a much more solid company that I think a lot of market participants give it credit for. This is a company that operates fully outside of the insurance system. This is a company that provides consultations and prescriptions. It's a combination. You get you get a virtual visit with a medical practitioner who will talk to you, and if they deem you a worthy candidate for a drug that could really improve your life, then they will prescribe that drug, and you will stay in contact with the prescriber of a drug throughout the administration of the drug. And they focus on minor health issues, like I said, such as, for example, ED is one of them, but they also focus on hair loss. They also focus on anxiety, minor things that need to be treated over the long run. And this makes this company very interesting because 95% of their revenue is recurring, and the company is just dirt cheap, trading at 2 times gross profit, and they are still growing in the 50% range. They actually guided up. They've updated that guidance up. So who knows how much they will end the year? Will it be 56%, or will they guide up again, moving us up in the 60% range? It's possible. Keep in mind, a company that grows revenue at 60%, theoretically, all else held equal, the stock price should grow 60%, or at least that's the way I view stocks. Like if your revenue grows 60%, your company is 60% bigger. And of course, if you value companies based on earnings, like I think a lot of legacy finance is still doing, of course you have a different view. But if you value companies like I do, to me, hyper growth stocks, I look at gross profit, I look at the margins held constant, and I tell myself, well, this is a stock that should be going up at least as fast as revenue is going up. At least that's the way I view a lot of my stocks. Let me move on to my data warehousing and my data monitoring stocks. Really briefly here. So, Datadog is infrastructure monitoring. So whenever there is an issue in a system, let's say an order is not going through on a website, somebody calls technical service, the order is not going through. The company is very complex, has warehouses everywhere, shippers, suppliers, different locations, different staff. Well, you would get into Datadog and you would look at, is there a problem somewhere in one piece of software or another? Datadog looks at all of the different logs from all of the different IT stack and really allows you to pinpoint, troubleshoot whenever there is a problem in your IT system. And modern enterprises are becoming IT powerhouses. They're becoming giant machines. They're interconnected. All of the systems are interconnected, and Datadog helps manage that. I believe this company is doing very well. This is a company, however, whose revenue growth has been steadily declining, as many of those are, because even though sometimes consumers are not as hyper aware of the economy, companies are, and companies do not spend as much on IT right now. And so we see longer sales cycle for a lot of this IT. This is the same story for all of these 4 stocks, by the way. We see a longer sales cycle because companies are holding off spending right now. They have a wait and see approach. They want to see the Fed pivot. And I do too, of course. And what else? We have Snowflake. So Snowflake is a data cloud. What do they call the data cloud? They offer data warehouses, data lakes. What is that? Well, there used to be a time when companies stored data on premise, right? They had servers in the basement and the data was all in there. Well, today they don't have to do that anymore. Today they store it in the cloud. That's what Snowflake does. Snowflake is the data cloud. It allows you to store in the cloud. Snowflake has a private competitor, by the way, in the name of Databricks, and they have a few competitors here and there. But what they have a lot of good things going for them. One of the things that they do is they allow sharing. So they allow companies to share data very, very quickly on their platform. So they're building a little bit of a network effect because of that. The CEO of Snowflake is Frank Slootman. Frank Slootman's written a lot of great business books. A lot of people give a premium to Snowflake because of Frank Slootman and what he did at ServiceNow. Nonetheless, I sold Snowflake a while now ago. I think it was 4 months ago that I sold it. Why? Because they halved their guidance. This was a company that was growing at 80%. And they just halved the guidance, and to me that's just insane. But you can see that as all of the other stocks are becoming more and more expensive, Snowflake has not moved too much. So we'll see what happens to stock like Tesla, Enphase. We'll see what happens to a lot of these stocks. As they keep moving up, maybe Snowflake relatively will end up cheap again. Anyways, maybe. Palantir is a good example of that, a stock that has been shot up because of a new association with AI. But Palantir's Foundry software has seen, lackluster adoption in my opinion, and I think a lot of the community that discusses Palantir, they focus a lot on discussing Foundry and Foundry, commercial adoption of Foundry, etc., and they forget about Gotham. And actually, when you dig into the numbers, you realize that Gotham grows faster than Foundry. Still today, Gotham grows faster than Foundry. They are the leader in military software and mission critical military software. They are the leading AI software in that space. And that's the main reason why I own Palantir. I own Palantir because I believe they have a potential to become the 4th military contractor in the military in the industrial complex, the U.S. military industrial complex. And if that happens, if they do that, in my view, this could be a multi-bagger. And I'm happy to own Palantir for the Gotham business, and Foundry is the icing on the cake, the cherry on the cake. I want them to succeed with Foundry, but right now, unfortunately, this environment for selling software is tough because companies are still hyper aware of what they spend. That may change quickly, though. If this bull market continues, there may be less pressure from shareholders to save stocks on these companies. MongoDB is a NoSQL database. Very strong community. Their Atlas database is very much loved by developers, and I think it has a unique positioning. Steady Eddie kind of company, as steady as it gets when it comes to the SaaS companies, and I think it's differentiated enough, but it's carved a very, very nice niche for itself, and that's exactly what I was saying earlier. Like if you see a NoSQL database being big in 10 years, and if you see databases being growing still as fast as they have, if you think data is going to be a big part of the future, which is what this is a big data mega trend, or at least 5 years ago they called this big data. Now I think this word is kind of coming out of style. But if you think data is going to be as crucial, much more crucial 10 years from now than it is today, then I believe all of these companies will benefit. And, just do the math, 28%, if they can sustain anything between 20 and, hopefully over 30, but even between 20 and 30 for 10 years, that would make for an absolutely outstanding return. And yes, we're not used to seeing a lot of companies that can do that, but this is a new era in technology, in my view. All of these companies are riding technology in one way or another and benefiting from this increased growth. Let me move on to cybersecurity. So cybersecurity stocks, surprisingly now, are becoming cheap. Let me just first get Cloudflare out of the way. Cloudflare, teeny tiny position. This stock is never cheap. I don't know why. It's always very expensive. I think it's got a huge following. You have a lot of people who only swear by Cloudflare. What is Cloudflare? What do they do in the cybersecurity space? They're a VPN for websites. They hide the servers of the websites that you use, and if you hide the server, you have no surface attack. You can't attack something that you can't see. And that's what Net is. Net has built an impressive network of VPN servers for websites that hide websites. In a nutshell, that's oversimplified. I know that's extremely simplified, but that's the way I look at it. Then you have CrowdStrike and Zscaler. These stocks trade hand in hand quite a bit, and they're equally cheap if you look at them right in the middle of a spreadsheet. But if you want to invest it in the SaaS world, one of the most powerful business models out there, by the way. If you like SaaS, these two, I believe, make a good pair. In my view, they make a good pair for me. CrowdStrike, what does CrowdStrike do? They're an endpoint security system. That means they secure your device. You install it on your device. Whenever there is a threat of your device, let's say you open a virus or something, CrowdStrike will intervene and stop that threat to infect your device. CrowdStrike uses network effects because whenever it learns from someone that there's been a threat somewhere on a computer, every single other computer that uses CrowdStrike will know that someone somewhere had that virus, and the software uses AI to detect those viruses. Very interesting business model. They're clearly leading in cybersecurity. In my view, they're clearly winning right now. Growth rate, is outstanding at 39%. Gross margin outstanding, as we're used to with SaaS. These are amazing businesses. And then you have Zscaler. And Zscaler and CrowdStrike, in my view, they go hand in hand. Because in general, when a company acquires CrowdStrike or some sort of endpoint security for their employees, they will also acquire a zero trust security. That's what Zscaler does. Zscaler does zero trust. So what is zero trust? Well, in the olden days, if a computer got infected, the whole network of the whole company would get infected. And that's why when you get into issues like ransomware, because you can have someone who gets into a hospital and they get all of the data and then they shut it all down. That's a problem. Zscaler solves that problem through zero trust. How do they do that? They allow that whenever a computer is infected, it can't infect another computer, and it can't get into the cloud. That means there's no trust between each devices. Each devices, when they log in with each other, or when you log into a main server from an edge device, every single time you need to authentify yourself. So there is no trust. There is no trusted movements between the different parts of the enterprise, and that's zero trust security. So in other words, CrowdStrike, prevents a fire in a way, and Zscaler prevents that fire from spreading if there were to be a fire. So let's say you have 1,000 houses, right? CrowdStrike prevents fires in the first place, and Zscaler prevents the fire to spread to all 1,000 houses and limits that fire to one house. I don't know if that's a good analogy. That's a pretty good analogy, actually. That's what they do. Going in hand, to me, I own both of those, bigger position in both of those than in Cloudflare. Cloudflare, maybe a bit of a cult stock at this point, but how many cult stocks do I have in here? A lot, right? I mean, there's a lot of people who love these stocks. Typically stocks are loved for a reason. If you go back and look at the returns of Apple, stocks are loved for a reason. The wisdom of a crowd is what it's called. Anyways, let me move on to e-commerce. E-commerce, let me just go ahead and do the same thing with Shopify. I'm eliminating Shopify. Shopify is a business that hasn't been doing too well. They failed infrastructure. They invested in these warehouses that didn't go so well. They had to go through many rounds of layoffs, and they're only growing at 20%. This is a decline that they've seen from the era of 2020. So in other words, I find Shopify to be very expensive. I think this also may have a lot to do with the fact that Shopify is a Canadian company, so a lot of Canadian funds want to invest in Canadian stocks, and so that may be one of the reasons why Shopify is my least favorite of the hyper growth stocks out of these three. I may be proven wrong. I don't know, but it's my least favorite. Then we have C-Limited. Now, C-Limited is a company that's doing very well, and one may be fooled when they looked at the number. They see 16%, and they're like, what's going on? It's not doing so well. Revenue growth 16% next year. What's going on? Well, what's going on is they have Garena Indonesia, and their Garena division, their gaming division, is losing a bunch of revenue because they had a one-hit wonder game called Free Fire that really caught up in 2020, and that India has banned, and that a lot of places in the rest of the world have removed. So the company level numbers are hiding the success of Shopee in Indonesia. They're hiding the success of their C-Money division. They're hiding all of this because of a decline in the gaming division. That's what makes this stock cheap, even though less attractive because of the gaming division issue, and it comes as a bundle. Unfortunately, we can't just invest in the e-commerce. We have to invest in the games, unfortunately. Nonetheless, a great stock. At some point, the game division will stabilize, and this stock will show revenue growth at the company level again. Let me move on to my favorite company out of the three. And in my view, this is a company that is still very inexpensive. That company is called MercadoLibre. MercadoLibre is the leader of e-commerce in Latin America. They're kind of a Latin American Amazon without AWS. No AWS there. But without AWS, they're the Latin American version of Amazon. They're doing very well in Brazil. They're doing very well in Mexico. Very well in Argentina. They know how to operate in Latin America where others do not, where others have failed. For example, C-Limited didn't do too well there. But even if you look at a company like Amazon, not doing so well over there. They have a lot of insider knowledge in the market. MercadoLibre, lots of good stuff going for it. For example, one of their main competitors called Americanas in Brazil went bankrupt, went out of business, so that really helps them out. What I'm impressed also with MercadoLibre is their ability to manage foreign exchange and forex. And so if you look at Argentina, yes, so the Argentine peso has had 100% inflation, but they've grown at 163% in Argentina. So they seem to be one of the few companies who's able to successfully manage Argentina for a share of their business. Anyways, fascinating company, growing really fast at 32%. The gross margin is really high. And again, a question that you have to ask yourself, going back to my style of investing, right? S-curves, adoption curves, e-commerce in Latin America, not as developed as in the US today. How big will it be in 10 years? Will e-commerce in Latin America blow up just like it did in the US, right? Will it be huge? And I believe it will be. And if it is, then you want to invest in the best in the space. The best in the space, in my view, for this region of the world is MercadoLibre. Another plus for MercadoLibre is that it's operating in a very dynamic part of the world. Lots of hope, lots of high growth, youthful population. There's a lot of demographic factors that I think will also benefit this company. So a lot of secular. Not only is MercadoLibre a bet, in my view, on the secular digital revolution of e-commerce, but it's also a bet on a part of the world that is seeing nice growth in my view. Let me move on to payments. Payments, I'll go very quickly. DLocal and Square, I'm not going to discuss them too much. Square, of course, in the US, Cash App, leading player, and then you have the Square of the payment terminals. That's fine. The problem with Square is that the growth is not very good at 9%. The growth is not very good, right? They're the leader. They're leading. It's a period. Unless you create another United States where they can lead again, it's going to be tough for them to grow, in my opinion, from here. So more mature. So that's the reason why it's a very tiny position. Another reason is the short report. They have a short report. They have lots of shorts. The same is true for DLocal. DLocal keeps being attacked by a relentless short seller, and that's one of the main reasons why that stock has dropped quite a bit. DLocal, nonetheless, interesting company, interesting play. They focus on digital payments for large companies, and they focus on transactions in a lot of emerging markets that have very disparate forms of payments, and DLocal focuses on that as a payment processor. So interesting company. My favorite company in there is StoneCo. StoneCo, pronounced Stonier, is part of a duopoly, in my view, in Brazil of payment systems for small businesses. And so small businesses, if you go to Brazil, small businesses, a popular way to pay is going to be more and more these payment terminals than StoneCo. So it's I think of StoneCo as the business of Square. Before we saw all of these little Square apps everywhere, the business of Square maybe 10 years ago, right? This is a business that was created much later, that has a much bigger runway to go. StoneCo also has a very interesting way to sell. They sell with community stores, so they have a lot of community stores within smaller communities, and they sell like that. And they also have a accounting business as part of their payment terminal. The company is culturally relevant. They sponsor Big Brother Brazil. They did that actually with MercadoLibre, which is another stock that I own. And like I said, they have one competitor, which is PagSeguro. The competitor is a little older. I've made deep dive on these companies, but this StoneCo, of course, today is extremely cheap, and the market is giving it no credit. Last thing I'll say about StoneCo, both Warren Buffett and Cathie Wood own StoneCo, which is crazy to think that these two agree on this one. But because it's both a high growth stock for Cathie Wood, and it's a super dirt cheap stock for Warren Buffett, so that explains a lot. Let me move on to the chip makers. The chip makers, I've discussed Nvidia quite a bit earlier at the start of this video. It's so expensive. I don't. That's all I have to say. I mean, you're paying a tremendous amount for that growth, even if their guidance comes true and the growth actually becomes much higher than 12%. They're going from such a high base. So we'll see how it goes. To me, the stock is so expensive right now, and I have sold it, albeit too early. I think a lot of people sold it too early. AMD, on the other hand, I find AMD to be relatively reasonably valued, although it's getting expensive, but it's relatively reasonably valued compared to Nvidia, and that is my main play left in the sector of the chip makers. And then you have Indie. Indie is a small player. It provides OEM with LiDARs, radars, ADAS systems. Kind of Indie right there should be looked at, kind of like STEM should be looked at in the energy revolution play, which is, tiny stock, very tiny position, more speculative in my humble opinion, view, no investment advice. Moving on to AdTech. My AdTechs, I have Pubmatic and the Trade Desk. The Trade Desk I've discussed a little bit at the beginning of the video. Getting expensive. Pubmatic is still very cheap, but Pubmatic is a much smaller sell-side player. By sell-side, we mean they sell space to advertisers, right? So they are working with publishers to sell space. Interesting positioning. Pubmatic actually has some infrastructure, which is different from a lot of these players. They're focusing a lot on their infrastructure, which can also explain why the growth is so slow, so small, so slow. The reason why these companies are showing low growth right now is because of, obviously, companies cutting spending on ads as they have been cutting spending on IT spend. So that's kind of a reason why we're seeing this slowdown. Let me move on to lifestyle stocks, and I have new stocks that I still need to rework this spreadsheet. I haven't had the time, but I will shortly. The lifestyle stock, you have Celsius, you have Lovesac, and you have Figs. Celsius is a company that I sold, I shouldn't have. I'm looking forward to get back into Celsius. This is a company whose beverage keeps eluding me, and I think a lot of people. This product is everywhere. If you live in the US, you see Celsius everywhere. They have the best locations in the stores just about everywhere, and people don't. I mean, a lot of especially younger millennials and Gen Z, they see, it seems like they don't get a Monster anymore, or they don't get a Red Bull. No, they get Celsius. Celsius has developed this kind of unique, youthful, sports-oriented brand that is really resonating with a large share of the consumer. And so this is what I call a lifestyle brand or lifestyle stock. They are doing very well, 67% growth, and they've had a wonderful partnership with Pepsi. Margin is very high at 42%. I mean, this is a beverage, right? Much of the cost of a beverage is transportation, and they're still pulling out these margins, which is impressive. And the Pepsi partnership probably helps them quite a bit. One issue with Celsius, in my view, is the Pepsi partnership. It's a double-edged sword. They make more money, but it can also mean that they may get acquired someday. And I believe Pepsi also has an option that could dilute the shareholder at some point. So the stock definitely has risks, but again, not exactly overvalued if you consider how fast it is growing. Again, this is just my view. Lovesac, briefly, that's beanbags. So the way I look at Lovesac, and I compare Lovesac, say, to Lazy Boy. If you're familiar with the US, Lazy Boy is kind of the couch of the then, right? The couch of before, and is there a revolution going on in premium furniture? That's what Lovesac's trying to achieve. Lovesac is trying to achieve. Let's be honest, though. The reason why Love is in this spreadsheet is because it is dirt cheap. Like, if you can find overstocks that trade at under a 0.1, right, a 0.10, please let me know. I mean, because there's only three of them, right? There's Lovesac, there's StoneCo, and there's HIMS. Please let me know if you can find another stock that is that cheap. They're extremely cheap. To me, this is clear anomalies of the market. That's the reason why it's in there. I don't have a propensity to love beanbags more than anybody, but it's like the product is resonating. They're seeing growth, right? 18% revenue growth. So people are adopting the product, yet they're dirt cheap. Figs is a company I've started covering. I've been disappointed by Figs, even though it's cheaper. I've been disappointed. I don't know if the product is really getting adopted. Figs is a company that is trying to pull off a Lululemon with scrubs. So Lululemon, the story of Lululemon, really briefly, they took yoga pants in the 90s. They were this obscure clothing that nobody was wearing, and they made yoga pants trendy, and everybody started wearing them, right? Lovesac trying to do the same thing. Figs is trying to do the same thing with scrubs. And who knows? Maybe scrubs will become mainstream. Maybe they won't. Anyways, tiny position. I am very careful with all of these here. With Celsius, Love, Figs, very careful. DigitalOcean focuses on micro businesses and small businesses, and they offer infrastructure cloud services, just like AWS. Except AWS is not easy to use sometimes, and it can be daunting and scary when you're a small business to use AWS. DigitalOcean is trying to provide a service for really focusing on the small business that also have cloud infrastructure needs. They have a niche. And the final business that has a niche in there is AXON. AXON is focusing on supplying police departments with things like self-defense, things like camera, things like cloud services. I do like AXON. I think it's an interesting company. They have a niche play. It's nice to be able to diversify your portfolio with sectors that are growing equally fast, right? You don't want to diversify in something that's not growing very fast, but if you diversify in something that's growing as fast as your average stock, and it's in an entirely uncorrelated sector, it can be a very, very powerful way to make sure you get that growth, at least in my view. So AXON, interesting play. A bit of a cult stock. I don't want to call AXON a cult stock, but there's a lot of people who love AXON. So this is kind of another thing to consider, which is why it may look a little more expensive on the expensive end of my spreadsheet, because you have a lot of people who really love this company, are very, very familiar. They're featured a lot also in police, like in shows with police officer shows, like I don't know, like the Rookie is one. There's a few other ones where they focus the products very much in there, and so they get some exposure on their products, believe it or not, in the mainstream in investor eye. So, anyways, let me move on now to my neobanks. The neobanks, we have Nubank and we have SoFi, and they've gotten steadily more expensive. SoFi has ran up much more than Nubank has recently. Nonetheless, I believe these companies are very interesting. They're the digital banks. They're the banks for the millennials, for the Gen Z. I believe younger people do not want to have to deal with a branch. When you go to a branch, people talk to you. How awful is that? That's not the modern way. The modern way is doing everything to an app. You don't want to have 3 people come on to you trying to talk to you when you walk into a branch, especially if you go deposit money or something like that. Like, what can I help you with? Oh, I have $2,000 on me. I want to deposit money. No, you don't. Anyways, the point is, these financial, these banks, these growing neobanks, new financial institutions, they are resonating with a younger consumer. And again, going back to that cost curve, the S curve, we're trying to get into companies. I'm trying to get into companies that are not adopted yet, right? SoFi has 5 million members. It's very high. It's a lot, but it could be much bigger in a country of 340 million. They have a tremendous runway for growth. Compare that to the biggest bank in America, JP Morgan. JP Morgan can only grow. Acquire another bank is how they've grown, but they can also only grow in times of crisis when the regulator allows them to acquire another bank, right? It's very, very, very tough to grow, right? When you have 60 million accounts, it's very tough to grow. When you have 5 million accounts, it's much easier to grow, right? What if SoFi just 5x's the number of customers, right? That's tremendous. The same is true for Nubank, by the way. Nubank is a leading neobank in Latin America, and they're resonating a lot with the customer. Nubank is a little different, but they're dealing with a lot of people who have never had banks. SoFi is dealing with people who are new to banking, or people who have had banks but are tired of paying fees and tired of paying too much. This is part of this mega trend of trending towards low cost or near zero cost. Lots of good things going for these two companies. SoFi right now ran up a little bit, but in no world would I call SoFi expensive, and in no world would I call Nubank expensive. The only thing for SoFi that I'll say, and I'll be a little careful with that, I made a video about SoFi 2 days ago, the only thing is they are getting into some sort of hype with the student loan repayments coming back, and you need to be careful. I am trying to be careful about that, in my view, because who knows, right? I mean, we know they're coming back for sure, but it's not the first time that I hear that they're coming back for sure. So I'm a little careful. This is, however, a business. The recent run for that business was due to the student loans, but the reason why I would invest in this business, in my view, has nothing to do with the student loans. This is a much bigger business than the student loan. This is a holistic business that deals with so many things that banks do. Anyways, love both of those stocks. I own much more SoFi than Nubank. Maybe it's a mistake. I'm trying to grow my Nubank position. Moving on to platforms, and I'll conclude with platforms. So we have Airbnb, Etsy, and Fiverr. Platforms, just like SaaS, they're a very powerful business model. Two-sided platforms, in the case of all three of them, two-sided platforms are much more powerful because you get network effects on both ends. Like, for example, Netflix is a one-sided platform. They have to produce that content. They don't get content from elsewhere. They have to invest that money and produce it one-sided. A two-sided platform like Airbnb doesn't have to produce housing. Right? They don't have housing exists and it's listed on Airbnb, right? And then consumers come, and so you have network effects on the consumer side that leads to more consumer to come to Airbnb because Airbnb has everything. And then you have on the supplier of housing, right? Room renters, house renters, they want to go on Airbnb because Airbnb has the most customers on there, and Airbnb just takes a fee on top of that. Airbnb is a very profitable business. Revenue growth is still forecasted to be very high at 22%, but keep in mind that this is a company that is bigger than hotels, in terms of their potential. There's a lot of induced demand that Airbnb creates that hotels do not create. Hotels are made for a very specific use case. I mean, you have a short use case on a road trip for lower service hotels. Higher service hotels, they have a use case for conferences, for example. But Airbnb is creating new use cases. Like, you go with friends because you want to, I don't know, take Instagram pictures, and so you decide to sleep in some airplane or whatever. That's induced demand, right? Induced demand is you're not planning on that vacation, but I don't know, your child really likes lions and you want to sleep into a room at a zoo that has view on lions, right? This is something that was not possible before. Airbnb is creating its own demand, which is I think very, very powerful. It's not just a competitor with hotels. Sure, they're taking away business from hotels, but they're also creating new demand entirely from scratch. That's the blue ocean strategy that so many of these companies follow, and Airbnb follows it as well. Etsy is kind of the same thing. Etsy is creating its new demand, right? If one shops on Etsy, they likely don't know what they want to buy. They get on there, and it's the AI that shows them something that they're likely to buy based on their browsing history. Very interesting company for Etsy. Fiverr is also very cheap right now, but the growth of Fiverr and Etsy, by the way, both of that growth has stalled. So I do not own these companies yet. I want to own them in the future. I don't own them yet. I do own Airbnb. I want to increase my position on Airbnb. Airbnb is one of these stocks that has not run up nearly as much as all of the other ones. Anyways, I have covered most of these stocks. A few I didn't cover yet, like the Trade Desk, for example. I haven't covered yet, but most of these stocks I have covered on the channel extensively. I've done deep dives on them, so feel free to go dig deeper if you're interested in learning or discussing any of these companies. None of this today was investment advice. This is just entertainment. I hope you were entertained. No investment advice. I appreciate your likes, appreciate your subscribes. Takes me a while to do this. Thank you so much for watching. Have a wonderful day.